Does Medicare pay for long-term care? And unfortunately, the answer is Medicare does not pay for long-term care. But there is an alternative way to pay for it, which I'm going to show you some examples here in a second. But the thing you have to keep in mind is that long-term care is expensive, and it really depends on the type of care that you need. So 44 hours a week of home health aid is $5,600 a month. You're looking at $4,900 a month for assisted living, and then between $8,900 to $9,800 for nursing home, depending on whether it's a semi-private or a private room. So regardless of the type of care that you need, long-term care can be very expensive. So the question then is, how are you going to pay for it? So we already know that Medicare does not cover long-term care. If you're one of the fortunate people that have long-term care insurance, that is a way to pay for long-term care, but very few people actually have long-term care insurance. Your family, they might be able to help pay for long-term care. Really depends on their financial situation, on whether they're able to do that or not. Medicaid could be an option, but you may or may not qualify for Medicaid depending on your income and asset levels. And then there are some areas that just aren't covered by Medicaid, which is crazy, but it's true. And then what most people are unaware of is that Medicaid has the ability to lien the estate. So Medicare, after the last spouse has passed away, could put a lien against the entire estate to try and get back some or all of the money that they've paid towards long-term care. So where most people end up at is paying for long-term care with their retirement savings. And the issue with that is, as expensive as it is it could be financially devastating to people and couples that are paying for long-term care. It could completely wipe people out pretty quickly. And the issue with that is, if it's a couple, is what happens to that remaining spouse if you've spent all the money out of your retirement savings. And then we also are typically looking at a loss of household income. So what is going to happen to that spouse financially when one of them passes away? And then on top of that, you have potential income tax obligations when drawing money out of a retirement portfolio. So there's just a whole lot of stuff going on here. So the alternative way to pay for long-term care is with a reverse mortgage. And there's several reasons to consider this. First and foremost is the ability to potentially access a income tax-free cash to pay for the long-term care. And instead of using retirement savings, you could actually use the reverse mortgage proceeds first to try and keep that retirement savings intact. You may not need any financial assistance from your family. And on top of that, you have the potential to leave the remaining spouse, when one of them has passed away, with additional funds to supplement their income throughout the rest of their retirement. So lots of different reasons to consider the reverse mortgage as a way to pay for long-term care. But let's take an example here. And here's the scenario of Mike and Allison. They're both 75 years old, $3,300 a month of income. They own their $600,000 home free and clear, and they have $300,000 in retirement savings. So again, this is typically not a couple that would ever think about or even consider getting a reverse mortgage. But in this situation, the reverse mortgage could be very beneficial to them. So the issue is Mike has dementia, and Allison just cannot take care of him safely anymore. It's a health and safety issue for both of them. And so what really needs to happen is he needs to go into memory care, and that's going to cost $9,500 a month. And after taxes, they only have enough money to pay for about 2 years worth of care in the memory care facility. On top of that, when Mike passes away, there's going to be about $1,500 a month of income that will be lost. So Allison's only going to be trying to live on $1,800 a month, which is going to be difficult for her to do. So Allison reached out to me to see if the reverse mortgage might be a good fit for them and help pay for Mike's long-term care. So option one was to get a reverse mortgage and to pay for memory care for 2 years with those proceeds from the reverse mortgage. So again, assuming Mike lives 2 years in memory care, use the money from the reverse mortgage to pay for that. And then once Mike has passed away, Allison would then start drawing $1,500 a month from the retirement savings. And the retirement savings is expected to last almost 23 years. So she wouldn't run out of money until she was 98 years old. That scenario is represented by this bar chart here. So the blue represents the home value, assuming a 4% appreciation rate in the home. The orange represents the loan balance, and we can see this loan balance is increasing over time. And the reason it's increasing is for 2 reasons. First and foremost, we know that Allison is going to pay for the first 2 years of Mike's memory care from the reverse mortgage. So as she draws money out of the line of credit, it reduces the line of credit, but it increases the loan balance. 2, we are assuming that Allison is not going to be making a monthly mortgage payment towards the reverse mortgage. She still has to pay her property taxes and her homeowner's insurance, but because she's not making a monthly payment, the interest and mortgage insurance are getting added to the loan balance. So for those 2 reasons, that's why this loan balance is increasing over time. So initially, the green is the line of credit. And initially, we're looking at 221, and we can see that drop significantly. So by year 5, there's only $46,000 in there. But again, that's because Allison is going to draw out about $102,000 a year for 2 years to pay for Mike's memory care. So what's interesting is you can see this line of credit is still growing. So even when she's 98 years old, Allison still has $96,000 in this line of credit. And that's because any funds in this line of credit are growing at the current interest rate plus 0.5%. So the other option that we looked at was to get a reverse mortgage as a backup after the retirement funds are spent paying for care. So in this scenario, we're going to use the retirement funds to pay for 2 years worth of Mike's memory care. And then beginning in year 3, Allison is going to start drawing $1,500 a month out of the line of credit to supplement her income. So again, what's interesting on this one is this line of credit. So initially, just in the previous example, we're starting off with $221,000. But in 5 years, that's $259. In 10 years, it's $265. So again, what's happening with this line of credit is any funds that are available are growing at the current interest rate plus 0.5%. So reality of Allison pulling out $1,500 a month, she's drawing out just the growth and actually a little bit less than what the growth that's happening, which is why this line of credit is growing over time. So again, in 10 years, let's assume that Allison is now 85, and let's say she needed to go into memory care. She could draw out this $265,000, prepay for a year or 2 or more of memory care. And then once that's happened, she could then, or her family would then sell her house, and she would net the difference between what was owed and what they sold it for, less realtor, title, and escrow fees. So then she has additional funds to continue to pay for her own care. So I think in those examples that there's some pretty good reasons to consider getting the reverse mortgage to help pay for long-term care. First and foremost is the reverse mortgage allows people to do better planning around care needs and finances. And what I mean by that is that you have the ability to bring in other professionals, whether that's a CPA, a financial planner, an estate planning attorney, etc., to help figure out what the best course of action is. And the fact that we are bringing in another source of funds allows people to get creative on how to best structure and make the decision on where is the best way and what source of funds is the best way to pay for that care. And it creates flexibility, which is huge, right? We have the flexibility of where funds come from because, again, we're introducing another source of funds. If they didn't get the reverse mortgage, their only option is to pull money out of the retirement savings. With the reverse mortgage, as you just saw in those examples, we can get pretty creative on how to pay for that care. Additionally, we are creating access to additional funds that could create financial stability for the remaining spouse. So again, instead of spending all of that money on care, and then the remaining spouse is now destitute, they've lost household income, the reverse mortgage could create an additional source of funds to allow them to supplement their income and also have a source of funds to help pay for other financial shocks that could pop up, whether that's healthcare costs, long-term care costs for the remaining spouse, home maintenance, things like that, that could be financially devastating. And finally, it creates peace of mind. Both spouses are going to feel better. There's going to be less stress. There's going to be less anxiety of what happens if we run out of money and what is the financial position going to be of the remaining spouse. Want to see how this would work for you, what your numbers would look like, and if it makes sense, give me a call. Happy to speak with you, answer any questions that you have, run some scenarios, do forecasting, look at your options to see if getting the reverse mortgage makes sense for your situation. There's no cost to speak with me. There's no obligation, and I look forward to speaking with you. Thanks. Bye.